Good morning, traders. Welcome to your 7-minute market update utilizing technical analysis to predict direction based on human emotion. Today is August 11th, 2012. Lots to talk about, so let's get started. So if I seem a little groggy in this video, it's pretty much 6:30 in the morning. Saturday morning, so I'm doing my analysis for you guys because I don't want to be too late in my videos. Of course, I'm trying to separate the videos from the market analysis and the stock pick analysis. So in any case, let's get started. This is the chart of the SPY, which is the ETF that tracks the S&P 500. All right, so now a quick recap. In the previous video, I had mentioned to you guys that I shorted the SPY. I believe at that level there, yes, definitely at this level here or this day here, by buying the SDS long, okay, because the SDS is a two-time short the SPY. So going long the SDS is actually shorting the SPY but times two. Okay, so that's why I went SDS long. Okay, and as you guys know that. I'm not totally getting rid of the options play because I do like options, I do like the leverage, but I'm going to be geared more towards actually shorting the stock or buying the stock. So in this case, I did not short the SPY, I just bought the SDS. Um, in the previous video, I did talk about, unfortunately, the only thing that could prevent this guy from coming down is the one and only, the one thing that I always talk about every single video is the volume. You see that? The volume on this day is it's way higher than the three volumes here. Okay, I take that back. It's not way higher. It's just definitely, obviously higher. However, high is great, but you see this blue line here? The blue line is the average, and the average right now is basically 150 million trades. Okay, that's the going rate right now is 150 million. So let's get started from this day here, which was August 7th. We had a volume of 109 million traded, okay, and then August 8th was 89 million, okay, so we couldn't even hit 100 million, all right, and then on Thursday we got 90 million, 1 million more. I mean, this is ridiculously low volume, right? We all know I always talk to you guys about volume and how important volume is, and when you have low volume, you have to give an upside bias to the market simply because the institutions can prop the markets higher. There is no selling pressure. There is no fear in the market, so the institutions can pretty much do whatever they want. They're the ones that can move the markets because they have billions of dollars. But let me tell you something: if the general population of traders are selling, there is no institution or no feds out there that can do anything about it. With doesn't matter how much money they have. Well, it does matter how much money they have, but they don't have enough money to prevent the markets from coming down. Okay, so that is the reason why the markets have not come down yet because of the volume. Okay, and then of course on Friday we hit 99 million. I mean, we still couldn't hit 100 million. All right, so the reason why I took the trade here even though on low volume is because, again, like I said in the previous videos, I didn't want to miss the train. I mean, had the volume picked up this week, I'm pretty sure we would have came down at least to this, back down to this, retesting this 20 moving average and possibly breaking down through it. But again, the volume is just not there, so obviously, we have to give an upside bias to the markets. Now, you notice, so today was, not today, 8/7 was Tuesday. Okay, so on Tuesday I took a short trade, and then Wednesday we gapped down. See, we opened down here, and because of the low volume, it floats higher. Okay, and then the next day we gapped down again. Right? Let me just zoom in here. Let me just get a little bit better picture. All right. So the next day we gapped down, and then we float higher again. And the next day, which was Friday, we gapped down again, and then we just float higher. Alright, so let me show you something else here. This is the 10-minute chart of the SPY, which again tracks the S&P 500, and as you can see, we gap down and we just float higher, and we have a nice sell-off right into support, and then we just kind of just basically, if you just look at this, we're just in a sideways channel just like this. Okay, low volume, the volume is just not there, and then towards the end of the day, right, we start floating higher, and look at that. This candle here, this is a 10-minute candle. 5.5 million trades in 10 minutes. Okay? And then the next candle is 5.2 million trades in 10 minutes. Nobody, in my opinion, as a retail trader, which is you and I, even if we were millionaires, we could not move the market like the market has moved in the last 20 minutes on Friday. It's not possible. This is normal. I mean, this is institutional game playing. I wouldn't say game playing, but this is institutional manipulation. This is not a surprise. You always see this, especially when you have a low volume day. Okay, so just keep that in mind that institutions, when you have low volume, not only will the markets just float higher, but towards the end of the day, you'll see a big spike to either direction, either up or down, and it depends on where they want the market to go. If they want to stop you out, if they want to do a head fake, stuff like that, it really depends. But this kind of movement in low volume on a low volume day is actually normal. Okay. All right, so still in the recap, I did say in the previous video. I had to watch the previous video, anyways, because I haven't been making a video every day. We still have this level here at 141.36, and I said that if we continue to have low volume, there is a possibility that we can reach the 141.36. We still have the 141.88 level, which is the purple line, which, by the way, has not been working out as well as I would have liked. In fact, it's only worked 1 out of 10 pink line for accuracy. What I mean is, for every 10 times the pink line is accurate, I only get 1 so far that the purple line is accurate. But I think I can use the purple line as a precautionary, meaning, in a low volume market like this, the 141.88 level or the purple line or these purple lines here would have to be considered, simply because, again, low volume upside bias, and this is exactly what I mean. Now, in any case, I do not see right now us getting into the 142.78. It is possible, but I don't see it as of now. Right now we have this up move here, and a lot of people are saying, oh, this could be bullish consolidation or a bull flag. Absolutely, I do believe that is a possibility. And some may say, okay, well, we have this up move here, and they stop the up move here, and then we have this kind of float higher. To me, in my opinion, this is not a bull flag. This is not a consolidation pattern. This is not, if you look at it this way, it's nothing. When you have an up move this way and you have a down move with a slight angle, there's a potential of moving higher, right? Everybody knows that. If you have an up move here and you have a 90-degree angle here, there's a potential of going higher. Everybody knows that. But then when you have an up move here and then you kind of angled higher this way, that is not consolidation in my opinion. But in this pattern here, it really depends on how you look at it, because guess what? You can look at this 2 ways. You have the top here, which is the candle of where I shorted the market. You can draw a line down here, and that could be, this diagonal or 90-degree angle for another push to the upside, possibly potentially getting into the 142.78 level before coming back down. Or, okay, the reason why I am still and I'm gonna take this more into account, and that's provided volume can come back into the markets. You notice, even though I shorted it at this candle, if I just draw a line from the top of this candle straight across, we're still unable to break through this level here. We were unable to get a close above this here, and again a confirmation above that. You see how that works? This candle here, when I took the short, which is buying the SDS long, it still has not been able to pass Tuesday's candle. It still has not been able to close above Tuesday's high. So that is still bearish to me, and I'm thinking, I don't know for sure, obviously, because nothing's 100%, especially in the stock market. I'm thinking that once volume gets back into the market, and again, as you guys know, I always talk about volume and how volume is important to me and how I trade. This is proof, this is proof in the pudding that it's very, very hard, not impossible, but very, very hard to short in a low volume market. I mean, a lot of professional traders think that way. I should say professional successful traders. For me, in my opinion, you guys all know how important volume is to me, and I will probably not take a trade if volume isn't there. I'm going to contradict myself because I did take a trade here, but that's simply because we were into resistance. and we're close enough to this 141.36, and that I had no way of knowing if volume was going to pick up this week or not, and obviously it didn't. So I'm waiting for the volume to come back into the markets. And again, nothing's 100%, but I think that once we start getting volume, and maybe if we run into this 141.36 level, then yeah, we should be coming back down. So Monday we could potentially hit this 141.36, and then Tuesday, Wednesday, Thursday, Friday, I'll come back down. All right. So here's the thing: Monday is a low volume day. I always say Monday and Fridays are low volume, right? You always hear me say that. Days before and days after holidays are low volume days, so we have to be more on the upside. So day trading, I would look for more long trades than I would with short trades on days like those. However, this Monday or next week, starting next week Monday, is the week that options expire. And as we all know, like I talked about in the previous videos, and we've seen time and time again, I think I've proven to you guys in my previous videos that the third Friday of every month is when options expire. We all know that. Actually, technically, options expire on Saturday. I don't even know why. You know, that's a good question. I have no idea why. But, the last day you can trade an option is on Friday. So the point is, on the week that options expire, you're going to have tons and tons of institutional game playing. We're going to get volatility. Okay, I would say, from my experiences, maybe, 8 out of 10 times you will see an increase in volatility in the markets. And volatility doesn't necessarily mean volume, okay? Remember that. But volatility in regard that the stock ETF or whatever you're looking at, you're gonna have spikes here, you're gonna have drops there, you're gonna have institutions trying to stop you out, and the reason is because they know that on Friday that options expire, and they don't want you to make money off of them, because guess what, they're the ones who are writing these options, not you. I mean, yeah, you can write options, but it's rare that you see a retail trader or even an options trader write options or write contracts for other people to buy. Yes, they do, but when you have like thousands and thousands of contracts being written, I mean, that's not the retail trader doing it, right? Obviously, because you're gonna need the stock to back it up unless you're writing, naked or naked calls or puts. But the fact of the matter is, the institutions out there, the hedge funds and whatever, they're trying to make as much money as they can by you not making money, obviously. So they're trying to take money from the retail trader. Us traders, like I tell you, we have to play like chess players, and our competitor, the people we're playing against, are the hedge funds. So you just have to keep in mind that next week is going to have a lot of head fakes. There's going to be a lot of institutional game playing. There's going to be a lot of, they're going to try and prop the markets higher to get everybody long and then just drop it. Or if the markets are going long, they're going to get everybody in long, the retail trader, and then short it. Okay, so they call that a short squeeze. Okay, so now keep in mind that because there's options expire next week, you're gonna have to look at this. Monday is normally a low volume day if it was not on options expiration. Okay, so keep in mind that there is a potential. So I am neutral for next week, Monday and Friday. Yes, Monday and Friday are normally low volume days, but if it falls on options expiration week, then I am now neutral for Monday and Friday. Anything can happen. All right, but because Monday and Friday are normally low volume days, and if the 2 out of 10 times the options expiration week does not have high volume, or not high volume but high volatility, then we're going to have low volume. And if we do have low volume, then this 141.36 level wouldn't be so bad. And then Tuesday, if we hit that on Monday, then Tuesday, when volatility or institutional game playing, or a lot of manipulation comes into the market, there's a possibility that we start coming back down at that time, or even as soon as Monday. Now here's the thing, it really depends on how many puts and how many calls and what the ratio is out there. If you got more calls out there than puts, then obviously the institutions are going to bring the markets down to stop everybody out of their calls, to make the calls expire worthless, that kind of stuff. But you know what? Let me do a quick check. There's no real way of finding out, but let me do a quick check here. Okay, there's no real way of telling, but from what I can tell, volatility has definitely increased on the call option buying. For the SPY, so that indicates that because there's more volume on the call side than the put side, there's a possibility that institutions will bring the markets down and start selling off to make more money on the call side because a lot of people are long the market. Now, in addition to this, I'm always a contrarian to CNBC and Goldman Sachs and everybody else, and that when you have this up move here and you hear bullish sentiment out there on the internet or on CNBC on the news and stuff like that, that means I'm pretty much gonna get ready to short. Okay, I mean, come on, honestly, if Goldman, I mean, let me give you an example. If Goldman Sachs upgrades a stock and says, buy this stock because I think it's going to go to $1 million a share. Well, guess what? Why would they do that for you? No, I don't know why, right? They're not making money off of you. Actually, they are if you go in the opposite direction of what they want you to do, or actually, what if you go in the direction of what they want you to do because they're opposite of what you're doing. I mean, okay, so let me just simplify this. Why will Goldman Sachs tell you what stock to buy? Right? They have obviously an investment into that stock, so why would they want you to buy the stock? They want to make money. They don't want you to make money, right? That's why GS is who GS is, right? So think about it this way: they have billions and billions and billions of dollars, so they have, say, millions of shares of a specific stock, right? Us retail traders, we buy 1 lot, 2 lot, 3 lots, maybe 1,000 shares, 2,000 shares. But never never 100,000, 200,000, or a million shares for that matter, right? So how are we gonna, for as retail traders, how do we offload? And not so bad if the volume is high in a specific ETF or stock, then we can get rid of our stocks pretty simple. I mean, pretty fast. We can sell it pretty fast. But Goldman Sachs has millions shares, millions of shares, or hundreds of thousands of shares. Who are they gonna offload it to, right? They need the retail traders to come in so they can offload their stock, and then in reality it drops. So let's just say Goldman Sachs says, and this is just my opinion, okay? So don't take this too hard, but this is just how I trade, all right? And this is what I think when I hear an upgrade from Goldman Sachs. So say you have a stock ABC that trades at $10, and Goldman Sachs goes, oh, buy it, buy it, buy it now. I think it's going to go up to $50 a share. Right? So obviously the retail trader watches CNBC and goes, "Oh, I better get in on it." And then, but they're like, "Yeah, but let me just wait and see." Right? So then you see, you bring up your chart software, and then you see the stock, or these other people that are not even chartists. They just look at Yahoo and they see the real time price go higher, 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 and then they're like, "Oh no, I'm gonna miss, I'm gonna miss my opportunity." So they jump in, they start buying, and everybody starts buying. The retail traders start buying. Who are they buying the shares from? You got to ask yourself that. Who are they buying the shares from? They're buying the shares from Goldman Sachs because they're the ones that need to offload the shares. They have too many shares. They have to sell it to somebody, so they announce this upgrade, and the average user goes in there, or the average trader goes in there, and they start buying it up, right? After Goldman Sachs sells the shares they want, then the stock crashes, right? I mean, we see that constantly over and over again. So maybe 3 days to 7 days after they make the announcement, expect a turnover as soon as 3 days. Okay, so if I see like something like this right now, CNBC is very bullish in the markets. We're close to this level at 141.36. We're close to this upper trend line here. I'm thinking once the volume comes back into the market, we start coming back down. Alright, so I really didn't notice the time here. I'm really sorry I'm into 18 minutes. I like to ramble, you guys know that, but I like to also tell you what I'm thinking when I make a trade. So, thank you very much for watching my videos. This is your 7-minute market update, and good luck to you all. God bless to you all, and I really appreciate you guys taking some time, or this 18 minutes out of your time or your day to watch my videos. I will be making a stock video update. I may not find stocks too short or to go long for next week, but I will at least update you of the previous stocks that I did mention in the previous video. Okay, I want to keep that updated. Again, I'm not making money on these these analysis videos. If you guys are, however, finding this very helpful to you, I'd appreciate it if you just did some sort of random act of kindness. Help an old lady across the street. Something as as simple as that. Or if someone is looking for donations for the Red Cross or something. I mean, if you only have a penny in your pocket, if you can just donate a penny, that'd be great. I mean, if you're finding these videos useful, if you're actually making money off of these videos, then yeah, I mean, that's all I ask from you. Other than that, then these videos are 100% free in my opinion. And not in my opinion, it is as of now. So again, thank you very much. I really appreciate you guys coming by. It really gives me a reason why to make these videos. Okay, so I hope to see you in the next video. And again, thank you very much.